Have you ever wondered how Islamic financial institutions handle their charitable side? Not just as, a general duty, but as a really specific financial framework. Today, we're taking a deep dive into the Accounting and Auditing Organization for Islamic Financial Institutions Standard. That's AAOII Shari'ah Standard NORDA 35 on Zakat. And this isn't just about charity in a vague sense. It's actually a pretty sophisticated system for financial accountability, blending age-old principles with, modern finance.
Exactly. It's an incredibly detailed standard, really. And our mission today essentially is to cut through some of that complexity. We want to pull out the most important bits about how Zakat is actually calculated and managed inside these institutions. We'll unpack how assets, liabilities, even tricky things like provisions and reserves are treated. The goal is to give you a solid understanding without drowning you in every single detail.
Right. So get ready. You might find some surprising facts, some clear insights into Zakat that could, change how you think about wealth in the Islamic financial world.
Okay, let's unpack this. So at its core, Zakat is, it's a specific right on certain wealth, right? Meant for designated people, a fundamental pillar. But for Islamic financial institutions, it feels like it becomes more than a personal thing. It's a big financial and ethical mandate. So what are the absolute basics, the conditions the standard lays out?
Well, most people know the basics like ownership, nisab, hal. But for institutions, it's about how these adapt. Take complete ownership. It means the wealth must be fully owned, fully disposable by the institution. Even funds set aside for future investment, they're still potentially zakatable unless they're specifically for paying off an immediate debt.
Okay, so ownership is key. What about the threshold, the nisab? Right, the nisab, the 85 grams of gold or 595 grams of silver benchmarks. But for an institution, the real challenge is its dynamic nature. Think about it. They have to constantly track the fluctuating value of this threshold, especially with liquid trading goods. It's not just a fixed number you check once a year. It requires real diligence.
Interesting. And the time element, the hal.
And hal, yeah. Usually it's 1 lunar year for cash, trading goods, livestock. But AAOIFI adds a little twist. If an institution uses a solar year, maybe for accounting convenience, the Zakat rate actually nudges up slightly, from 2.5% to 2.577%.
That's small, but significant for the books, I imagine.
Exactly. It seems tiny, but it's a critical detail for accurate reporting, often missed. And remember, for things like crops, minerals, treasure Zakat's due right away. At harvest or extraction, no waiting for the hal.
Okay. So if you're an Islamic financial institution, you've got your balance sheet out, how do you actually start calculating the Zakat? What's the method?
The standard, AAOIFI 35, it's very clear. It mandates the net assets method. Basically, it's a net calculation. You take your Zakat assets, then you subtract certain eligible liabilities and specific rights. The balance sheet is your main tool here, the income statement. Less so for the Zakat calculation itself, more for tracking income from fixed assets. And here's something that often surprises people. Zakat is generally due even if the institution didn't make a profit that year.
Really? Even if it's unprofitable?
Yes. Unless its liabilities are so massive, they essentially wipe out all the assets. Profitability isn't the trigger. Owning zakatable assets above the nisab for a hal is.
Wow. Okay, that's a major point. And this is where it often gets debated, right? Does the institution pay the zakat itself, or does that obligation pass through to the shareholders?
Good question. The standard says the institution must pay directly if it's required by law or if it's written into their own articles of association or if the General Assembly votes for it.
So it can be mandatory.
It can be. It definitely streamlines things. It's also possible if the institution acts like an agent, gets power of attorney from shareholders or investment account holders. But they need specific funds set aside for that. And crucially, there needs to be coordination between parent companies and subsidiaries to avoid paying zakat twice on the same wealth.
Makes sense.
And any Zakat fund or account set up by the institution, it needs the green light from their Shari'ah board. That adds an important layer of oversight. Now, if the institution doesn't pay directly, it has a duty to clearly state the Zakat amount due per share or per investment unit, so the individual owners know exactly what they owe.
Okay. That foundational understanding is really helpful, knowing the principles, the calculation method, who pays. But now the granular work starts. Identifying what exactly is zakatable wealth. Let's dig into the specifics. What kinds of assets are we talking about inside an Islamic financial institution? What's in, what's out?
Right. Let's break down the assets. First up, the obvious ones. Cash and easily liquidated assets. Physical cash, gold, silver. Those are zakatable based on weight or their monetary value. Now, bank accounts get interesting for institutions. current accounts held by the institution. They're zakatable because they're seen as loans due to the institution.
Okay.
And if there's any interest earned, which, of course, is forbidden,
Right.
the principal amount is still zakatable, but that interest has to be given away to charity immediately. Now, for the bank holding the account, those deposits are liabilities, naturally.
And investment accounts.
Investment accounts. This is a core principle. Zakat isn't just on the deposited amount. It's due from the owners of the accounts based on the value of the underlying assets the money is invested in.
So you look through the investment vehicle to the actual wealth.
Exactly. Zakat follows the productive wealth. For the institution managing these accounts, it's like a trust. Only their share of the profit or their management fee is part of their zakatable assets. And again, any forbidden interest, straight to charity. The principal remains zakatable for the account owner.
How does that apply to things like bonds or sukuk?
Similar logic. For conventional interest-bearing bonds, again, forbidden the principal is zakatable for the holder. The interest part is illicit, has to go to charity. For the issuer, it's a liability. But for investment sukuk, which are structured to be Shari'ah compliant, the holders pay zakat based on the underlying assets the sukuk represents. It reflects what they actually own, not just the paper value.
So it mirrors the underlying economic reality.
Precisely. And investment funds work the same way. Zakat depends on what the fund actually holds, the underlying assets.
Okay. What about specific cash amounts held for particular transactions, like guarantees or deposits?
Yes, specific held amounts. Things like earnest money, performance guarantees for tenders, cash deposits for services. The key here is always, who truly owns it when zakat is due? Take performance guarantees. The institution receiving the guarantee can usually deduct it from their zakatable assets because it's contingent, not fully theirs yet. The institution providing the guarantee pays zakat on it only if they could theoretically invest that locked amount annually. Otherwise, zakat is due just once for 1 year when they eventually get it back.
Okay, that's quite specific. What about a down payment?
A down payment, an arbun, that's different. If you're the buyer making the down payment, you don't deduct it. But the seller, it is zakatable for them immediately because they now legally own that money.
Right, ownership transfer. Now, beyond these financial instruments, many Islamic institutions are involved in commerce. Trading goods must be a big category.
Absolutely. Trading goods, or arud al-tijara. This is fundamental, the defining factor, the intention to trade. So any asset, real estate, movable goods, whatever, acquired with the specific plan to sell it on, whether they bought it or manufactured it.
And how do you value it?
Generally, at its market value for sale when zakat is due. If that's hard to pin down, you can use the cost price. And here's an important nuance. If something qualifies as a trading good and also falls under another zakat category like livestock, you only pay zakat on it as a trading good. It avoids double counting.
Simple is better there.
Definitely. And while you usually pay the zakat on trading goods in cash, if the market is really slow, like in a recession, the standard allows paying in kind, giving some of the goods themselves, if that's better for the recipients.
That's practical.
Very. And if goods are sold but not yet delivered, zakat is due immediately by the buyer because ownership has technically transferred.
So what falls under this trading goods umbrella?
It's broad. Raw materials meant for trading. Inventory, even if it's slow-moving or a bit defective, goods being manufactured, construction work in progress if it's being built for sale, goods in transit, consigned goods, even intangible things like copyrights or software if they're held with the intention to trade them.
Okay. What's not included then?
Good question. Things like industrial tools, spare parts for factory machines, those are operational, not for trade. Also, basic packaging materials that don't really add intrinsic value to the product itself. It highlights that zakat focuses on the productive wealth, or wealth intended for sale, not the tools used to make it.
Got it. Now, what about money owed to the institution? Receivables, or money the institution owes, payables. How do they fit in?
Right, let's talk receivables, or Dima Medina. The general rule is pretty straightforward. Debts owed to the institution are zakatable every year. Doesn't matter if they're current or deferred, as long as they're considered recoverable.
Recoverable being the key word.
Exactly. Because doubtful debts, or bad debts you probably won't collect, those are not zakatable until you actually receive the money. Once you do receive it, you pay zakat for one past year. Or institutions have a choice. They can wait until collection and then pay zakat for all the past years it was outstanding.
And provisions for those doubtful debts.
Provisions for doubtful debts are deductible from the institution's zakatable assets. That makes sense, right? You don't pay zakat on money you realistically expect not to receive.
Makes sense. What about interest on debts owed to the institution?
Again, any usurious interest component is strictly forbidden. So only the principal amount of the debt is zakatable for the institution receiving payment. Any interest part, illicit, must be given to charity. This applies across different contracts, like in Mirabaha sales or Istisna manufacturing contracts. The principal amount owed to the institution is what's zakatable.
Okay, that clarifies receivables. Now, stepping back slightly, what if an institution holds more traditional assets, like farmland, minerals, or livestock? Does the standard cover those too?
It does, briefly. For crops and fruits, the nisab is about 653 kilograms, 5 wask. No haul here, zakat is due at harvest. The rate depends on irrigation, 10% if rain-fed, 5% if irrigated, 7.5% if mixed. Each crop type has its own nisab calculation. Things like land repair costs aren't deductible, but the cost of delivering the zakat produce to recipients is.
And minerals?
Minerals cover pretty much anything extracted, liquid, solid, gas from land or sea. The nisab is the value of 85 grams of gold, rate is 2.5%. But if the state owns the resource, no zakat applies, and things like pearls, coral, or fish. If they're extracted for trading, they just get treated as trading goods.
Simple enough. Livestock?
Livestock, camels, cattle, sheep. Zakat applies if they're kept for milk, breeding, or offspring, and they graze freely for most of the year. But if they're kept mainly for trading, then they fall under the trading goods rules we already discussed, and working animals, like for plowing. Not zakopal. The standard has detailed tables for specific numbers and zakat amounts for livestock. It's quite comprehensive.
Okay, this next area often seems quite complex for finance professionals looking at zakat. What about fixed assets? The buildings, the equipment, and how do loans the institution takes out, or those accounting entries like provisions and reserves, play into the calculation?
You're right. This is where things can get intricate, but the standard aims for clarity. Let's start with fixed assets, mawjudat thabita. The key is the purpose of the asset. Operating fixed assets, think office buildings, computers, machinery used in the business, even intangible assets like patents not held for sale. These are not zakatable themselves, they're tools of the trade.
Okay, not zakatable. What about assets that make money, like rental properties?
Good point. Income-generating fixed assets, things like properties rented out, real estate held for investment appreciation, maybe even projects under construction that are already generating income. The assets themselves are generally not zakatable. However, any net income they generate, which is still sitting there unspent at the end of the zakat year, that net income gets added to the institution's other zakatable assets, and zakat is paid on it.
So not the asset, but the cash flow it generates and retains.
Exactly. Now, equity investments are interesting. If the institution holds shares in another company for long-term growth or just to retain them, zakat is due on the portion of the underlying company's zakatable assets that those shares represent. You have to kind of look through the share certificate to the real assets.
What if you can't figure that out?
If it's hard to determine the underlying zakatable assets, then zakat is calculated on the remaining net income received from those shares at the year end, similar to the income-generating assets. And importantly, provisions made against the value decline of these long-term investments, usually not deductible for zakat. Zakat follows the underlying reality.
But what if they hold shares just to trade them?
If they're held explicitly for trading, then they're just treated like any other trading good valued at market price. There's also a special case for subsidiaries where the parent owns over 50%. The subsidiary calculates and pays its own zakat independently. The parent company then pays zakat only on its proportional share of ownership based on the subsidiary's calculation. This prevents double zakat.
And the minority shareholders?
Minority interests are handled by those shareholders themselves, or that portion is deductible from the parent company's consolidated zakat base.
That's a very clear breakdown for fixed assets. Okay, let's switch to the other side, liabilities, or matlubat. What debts can an Islamic financial institution actually deduct when calculating zakat? This seems like it can make a big difference.
It absolutely can. And this is where you really see the difference between conventional accounting and Shari'ah principles for zakat. First, a crucial point. Some things listed as liabilities on a balance sheet, like share capital, reserves, retained earnings, these are not considered debts from a zakat perspective. They're part of the owner's equity, the institution's wealth, not a claim against it.
So equity isn't deductible. What is deductible then?
Deductible debts are generally those incurred specifically to acquire zakatable assets. Think about current accounts payable by the institution or investment accounts they manage for others, money owed to suppliers for goods or services, debts related to salam or istisna contracts before goods are delivered, bills payable, short-term loans used for working capital, accrued expenses, taxes due. These typically reduce the zakat base.
Okay, so debts linked to zakable assets are deductible. What about debts for fixed assets?
Generally, debts taken out to buy non-zakatable fixed assets like that office building we mentioned are not deductible from the zakat pool.
What if you can't tell what a loan was used for?
Good question. Mixed purpose debts. If it's unclear whether a loan funded zakatable assets or non-zakatable ones, you apply a proportional deduction. Say, if 40% of the institution's total assets are zakatable, then you can deduct 40% of that unidentified debt.
That's logical. What about interest-bearing loans, since interest is forbidden?
Illicit debts. The treatment is strict. Only the principal amount of an interest-bearing loan can potentially be considered for deduction if it meets the other criteria, like funding zakatable assets. The interest portion itself. It's illicit, not a valid debt in Shari'ah, so it's never deductible.
Okay. Any other nuances on liabilities?
Just a couple. Revenue received in advance for services you haven't performed yet. That's usually deductible because ownership isn't fully settled. But advance payment for goods, even if not delivered, generally not deductible for the seller. Also, customer deposits held temporarily, like for utility bills, and minority interests on a consolidated statement are typically deductible from the institution's zakat base.
So it really comes down to the Shari'ah nature and purpose of the liability, not just its accounting classification. Which leads us neatly to those other accounting entries, provisions and reserves. How do they fit into the zakat picture?
Yes, this is another area where AOIFI provides really important guidance. Let's distinguish provisions, mukassasat, from reserves, itiyatat. Provisions are set aside for liabilities that are uncertain or for expected decreases in asset values. Now, generally, provisions related to fixed assets like depreciation or amortization, or provisions against current assets, maybe for slow-moving inventory or expected price drops, these are not deductible from the zakat base.
Why not?
Because the zakat calculation for assets, especially trading goods, usually relies on their current market value. The provisions are accounting entries reflecting book value, not the market reality that zakat often looks at.
Okay. What about provisions for actual liabilities?
Provisions for liabilities are different. Things like provisions for taxes do. Those are deductible because they represent a definite existing obligation. But provisions for things like employee vacation pay or end-of-service benefits, generally not deductible unless the amounts are actually paid out or legally due and payable within the current zakat year. Provisions for potential legal compensation, only deductible once a court judgment makes it final and payable.
So it needs to be a concrete obligation.
Pretty much. And again, if any provision accidentally includes some forbidden interest calculation, only the lawful principal liability part can be considered for deduction.
Got it. Now, what about reserves?
Reserves. These are different from provisions. Reserves are amounts taken from profits and allocated for specific future purposes, like a legal reserve or a reserve for future expansion. Here's the absolute key takeaway. Reserves, by their very nature in Shari'ah, are not debts owed by the institution. They are part of the owner's equity, essentially, retained profits or capital, meaning all types of reserves are considered zakatable as part of the institution's owned wealth. They are never deductible from the zakat base. This includes statutory reserves, general reserves, revaluation reserves, reserves for proposed dividends, even retained earnings sitting unallocated. They all represent wealth owned by the institution and are subject to zakat.
That's a very clear and important distinction. Retained earnings, even if earmarked, are still part of the zakatable wealth.
Okay. So we've gone through the calculation, the assets, the deductions. Zakat is calculated. Who gets it? How is it distributed?
Right, the distribution. Zakat has designated recipients, the famous 8 categories mentioned directly in the Quran, in Surah At-Tawbah. Everyone knows the first 2, the poor, fuqara, and the needy, masakin. But the standard acknowledges all 8. Zakat administrators, amalin alaya, those whose hearts are to be reconciled, mu'afatu ulubun, for freeing captives, fi al-rikab, those in debt, garimin, in the cause of Allah, fi sabilillah, and the wayfarer, ibn al-sabil.
And the institution decides how to allocate among these. Yes, the institution's Shari'ah board plays a key role here. They interpret what each category means in today's context and determine the priorities for distribution based on need. It's not just a list. It requires careful judgment.
That makes sense. So beyond identifying who gets it, are there specific rules or maybe some flexibility in how and when the zakat is actually paid out by these institutions?
There are. The ideal is prompt payment. As soon as zakat is due, it should ideally be distributed. However, the standard recognizes realities. Payment can be delayed for a short period, say up to a year if there's a valid reason, maybe a temporary lack of cash flow, or if delaying allows for better planning or coordination of distribution, what's called maslaha, or public benefit.
Okay, some flexibility there. What about forgiving debt? Can that count as zakat?
Generally, no. Just forgiving a debt doesn't automatically count as zakat. The exception is if the debtor is already eligible to receive zakat, like being poor or needy and there's no funny business, like a prior agreement that the loan would be forgiven as zakat. Institutions are also encouraged to set up a dedicated zakat fund or account for transparency and proper management.
Can they invest that zakat money before distributing it?
Interestingly, yes, zakat funds can be temporarily invested, and this is crucial only if the immediate needs of current recipients have already been met.
Yeah.
And there must be strong safeguards against losing the money. The goal has to be generating more funds for future zakat recipients, not making a commercial profit for the institution itself.
I'd say it's a careful balance.
It is.
Gotcha.
Also important. Zakat obligations don't expire. There's no statute of limitations. If zakat was due years ago and wasn't paid, it's still owed.
Wow.
Institutions can also pay zakat in advance before its due date if their Shari'ah board approves. And it's perfectly fine to pay the zakat in monetary value instead of in kind, like giving cash instead of actual cross.
And do they have to give to all 8 categories?
Oh, no, it's not mandatory to distribute to all 8 categories simultaneously. Institutions can prioritize based on the most pressing needs they identify. And finally, zakat funds can be transferred and distributed in a different location from where the wealth was generated if the Shari'ah authorities deem there's a clear benefit or need elsewhere.
Wow. We've really covered a lot. This deep dive has certainly unpacked the very intricate world of zakat within Islamic financial institutions. It really shows how deeply embedded these ethical and social duties are in their actual financial operations. It's clearly much more than just writing a check.
It really is. What's striking is just how meticulous these AAOIFI standards are. They aim to ensure wealth circulates properly, benefiting society, while also giving very practical guidance on complex, modern accounting situations. It feels like a truly holistic approach to managing finance.
So thinking about all this, what does it mean for you, the listener? Maybe it makes you think a bit differently about what financial institutions do in society, or perhaps the ethical layers behind managing wealth, even outside a purely Islamic framework.
It really raises a bigger question, doesn't it? In a world that's constantly dealing with wealth inequality, corporate social responsibility, what lessons can we take from such a detailed, principled framework for compulsory charitable giving? How might this kind of deep thinking about the purpose of wealth, beyond just making more of it, inspire wider conversations?
That is a powerful thought to end on. Thank you so much for joining us on this deep dive. Until next time, keep digging for knowledge.